Forex intervention, a central bank market action that terrifies Forex traders, has caused many Forex market speculators to suffer heavy losses in recent years, while those traders with skull-like sharp sights have made substantial profits. So what exactly is Forex intervention? Forex intervention primarily refers to actions taken by a sovereign nation's central bank or financial department to buy or sell large amounts of its currency in the open market using national foreign exchange reserves. The ultimate goal of these actions is usually to artificially adjust its exchange rate up or down. In the post-pandemic era, major Western economies, led by the United States, have started a frenzy of interest rate hikes to recoup the massive funds released during the pandemic through quantitative easing policies. In less than a year, interest rates in various countries have risen sharply from near zero levels. For example, the U.S. Federal Reserve's federal funds rate soared from 0% to 5.25%, while Australia's rate rose from 0.1% to 4.25%. In contrast, Japan, which has been in negative interest rates for years, was still struggling with a weak economy and did not immediately raise rates after the pandemic. This has widened the interest rate gap between Japan and other Western countries. Clearly, the larger the interest rate gap, the lower the value of the low-interest currency. The exchange rate of the US dollar against the yen has risen from $1 equals 100 yen in March 2020, the lowest point during the COVID-19 crash, to $1 equals 160 yen in July 2024. The huge interest rate gap has caused many short sellers to suffer heavy losses. However, a few sharp short sellers have made substantial profits by accurately predicting the Bank of Japan's Forex intervention. For example, in September 2022, the Bank of Japan launched its first Forex intervention in 23 years, using $59 billion in foreign exchange reserves to directly buy yen in the international Forex market. The large demand and purchases immediately pulled the yen back from 145 to 140 and further to around 138 in the following weeks. In April and May of 2023, as well as in July 2024, the Bank of Japan continuously took action, quickly raising the value of the yen in a short period, causing the dollar-yen exchange rate to plummet. These short, sharp declines became a source of profit for savvy short sellers and a nightmare for dollar-long traders. To this day, the dollar-yen exchange rate continues to climb, and the depreciation of the yen has placed a significant economic burden on Japan, which heavily relies on resource imports. Now that the yen has approached the 160 mark, will the Bank of Japan intervene again?